Venture Capital Part 1. Okay, so we're now graduates of years 0 to 1. We've raised some seed money. You used amazing presentation skills to raise money. Okay, you raised it from angel investors or seed investors. Those are just terms for people that fund early stage companies by giving them a couple hundred grand to start a firm. All right, so your company is now a bit bigger, right? You start generating revenue, and now you need a lot of money, okay, to get to the next level. And so I don't want you to use a bank ever, okay, because remember, early on with banks, if you miss one payment, they will seize everything in your company. They will terminate your company. They don't care. They're ruthless. They're bloodsuckers. Okay, what I want you to do is deal with equity investors, meaning high net worth investors or venture capital firms or corporations that can buy part of your company. They'll give you cash and they'll own a percentage of your firm. And so we're going to do the A round now. Okay, there's a firm called Sequoia, which again is the best venture capital firm in history. We'll talk a lot about them and the other firms later, but they're going to lead the A round, which is the first round of venture capital money, which means institutional money. Okay, and we'll raise money from them. We already know how to present because we kicked ass last class presenting, and so we're going to raise money and we're going to build our business. So we're now in years 2 to 3. Okay, and so this is the first part of venture capital. There's 3 parts to VC that I will be discussing, 3 different classes. Why? Because venture capitalists are pretty astute when it comes to picking the right companies to back. And so I'm going to give you their secrets so that you can start your own company and pitch your business model to them. And even if you don't want to start a company, from a business perspective, it's very important to know a lot of these concepts. Okay, great. So let's kick it off with what is the most important investment characteristic? See if you can guess. Okay, so it's not, is this a good business model? It's not at all. It's actually management. The jockey is always, always more important than the horse. Okay, the jockey is more important than the horse. Okay, the business model is irrelevant unless you have a great management team. And business schools don't teach this for some reason. I remember when I worked on Wall Street after my MBA, I would analyze companies to death. I would look at their valuation, their financials, their market positioning, the competitive environment. But we wouldn't analyze management teams, which is ludicrous. So make sure you have a great management team. Okay, and so if you're going to invest in a company, for example, how do you do channel checks on a management team? How do you find out if they're any good? Well, you want to make sure that that management team has had past exits, okay? Meaning, have they sold companies in the past that they've started or been a part of groups that have sold companies? You also want to make sure that their employees like them, like working for them, they respect them. How do you tell? Well, you can quantify this by going to glassdoor.com, that's GLASSDOOR.com, and do a search on the company. If it's a big publicly traded company like Salesforce or Tableau Software or Splunk, do a search on those companies, and you'll see that the feedback from the employees that work at those companies is universally positive. Those 3 aforementioned companies all get grades over 90%. That's how you can do your due diligence. Otherwise, what you can do is you can just do a search in LinkedIn to see if you have someone in common or a second degree connection with somebody you might invest in, okay, the management team, and just call your friends up and just find out if these people are respected and if they can deliver. And usually they've sold companies in the past. And so in venture capital, we like to back people that have been successful in the past. And so in the public markets, there's a notion that past performance is not indicative of future performance. But in the private markets, it is. That's a very controversial statement, so I'll pause here. Okay, so your probability of making money investing in somebody that's had a past exit is materially higher than backing somebody that's never started a company before. And so you might say, well, Chris, I've never started a company before. That's not true. I mean, Mark Zuckerberg was very successful and he never started a company before. In fact, he was a student when he started Facebook at Harvard. Well, the reason he was successful, among many reasons, is because he surrounded himself with very competent board advisors. Okay, and I'll tell you how to get them in a second. But his investors and board advisors included Peter Thiel, as well as Sean Parker and Justin Timberlake. Oh, no, not Justin Timberlake. That was from that movie, the Facebook movie, whatever. But anyway, you get the idea. He surrounded himself with very competent people. So how do you do it? Okay, let's assume that you're a student at San Francisco State. Okay, great university. What you can do is you can go to LinkedIn, like we talked about earlier in this course, do an advanced search, okay, and think to yourself, if I had people on my board of advisors or board of directors, would I look more credible? Could I use their tutelage or their help? Can they be a Yoda to me? And so what you do is this. Let's say you start a software company, and it would be really cool if you had somebody from Google on your board advisors. Well, what you do is this. You go to LinkedIn. You do an advanced search like we talked about earlier in the course. You enter the word Google in the keyword space. And for the school, you select San Francisco State University or Stanford or whatever school it is you went to, right? And then you select the zip code that you live in right now. And then you search that zip code to see if anybody works for Google, for example, that also went to your university. And then you set up an informational meeting with them. And keep in mind, remember, you have to ask in life to get what you want. Steve Jobs, remember that video? Steve Jobs ask. We wouldn't be using Apple products today if it weren't for him. You need to ask for help. Okay. So what you do is in LinkedIn, you have this person that went to the same school as you that works at Google or whatever company it is you want to approach, and you send a short message like this. John, hope all is well. I'm also from Canada and I live in the Bay Area, or I also went to San Francisco State and I live in the Bay Area, or I also went to, NYU and I live in the Bay Area, or I also went to IIT and live in the Bay Area. Please let me know if you have time for a coffee in the next few weeks. Thanks, Chris. And remember, it's just an in-mail, not an email, an in-mail, right? And this works. And when you get that meeting, right, with somebody you want to be on your board of advisors, you sit down with them. In the first half of the meeting, just get to know them better. Business is about relationships. Your relationships are more important than product knowledge. Get to know them. Okay, and so the first 30 minutes of the meeting, just get to know them. Talk about what you have in common, like the school you went to, or if you're from Bombay or Toronto or wherever it is, the city you're from. Remember, the farther away you get from home, the more people want to help you that have something in common with you. Okay, and then what you do is towards the end of the meeting, just ask them very casually, thank you very much for your time. Please let me know if I can ever call upon you as an advisor every now and then. And then they'll most likely say yes, because people feel like it's a huge compliment that you're asking them. And then say, great, I'll call upon you every now and then as my board advisor. Thank you so much for your time, or whatever it might be. And then meet up with them every 3 to 6 months. And after that meeting, remember something you talked about in that meeting that this other person you met with thought was interesting. And follow up by adding value to them by sending them an email or a LinkedIn message with something interesting on that topic. And in the months ahead, send them messages every now and then to help them out with their business based on whatever you talked about. I know it sounds generic, but you need to help them as well longer term. And so what I just showed you was how to get a board of advisors. Okay, so say you want people from Google, Facebook, other firms on your board, you can do it. All you got to do is ask. You know why? Nobody asks. Nobody asks. And that's a great thing for us because there's less competition for us. Ask and you shall receive. This has been true since the beginning of time. And even if you don't want to start your own company, what you can do is if you want to get a job or get a customer, you can use this exact same methodology. Meet with these people, right? Get to know them and then ask. And say you want to get a job through this methodology. You're sitting down with this person, right, that works at Google, for example, and you want to work at Google. After the first half hour of talking about what you have in common with a person, then say, is Google hiring, right? And if they say yes, great. They'll introduce you to somebody in Google that might be helping out from a recruiting perspective. Or if they say no, it's okay. Here's what you do. You say, okay, can you please let me know when you might be hiring? And if they say in 2 months, then you reach out to them again in 2 months. Okay, so relationships are more important than product knowledge. Back to VC capital raising and terms. Okay, so I'm going to talk a little bit about venture capital here, just so you understand the industry, because it's very important when you want to raise money. Okay, so who are the investors or the LPs, the limited partners? Remember we talked about that? Investors are usually high net worth investors or big endowments or pension funds. Okay, what are the terms? How do VC firms make money? Well, venture capital or VC firms make money in two ways. One way is they charge a 2% annual fee on the money that you invest in them, right? And that just pays for salaries, rent, expenses. And here's the kicker. They make most of their money on what's called the carry, which is a 20% incentive that they get. So what does that mean? Well, let's say you invest $100 in a venture capital firm, and you make 10 times your money. So you make $1,000. About 20% of that will go to the venture capital firm. They'll make $200 off of you, and you'll make $800. 2 and 20. Those are the terms. And hedge fund industry works the same way as well. An annual 2% management fee and a 20% incentive. Okay. Next up, the third bullet point. Remember, you don't want to put too much stuff on the slide. How do you harvest an investment? If you're a venture capital firm, how do you harvest the investment? Well, what you can do is the company you invested in, right, the startup, like your startup, it'll either go public or get sold to another company. That's called harvesting. Okay. And so venture capital is a way for big pools of capital to invest in private companies. Okay. And the investment stages for your startup are as follows. And we talked about the seed stage, which we did in class 1 and class 2. Remember, you started your company and then you presented to investors, right? So the seed stage is the first stage when you kind of have a product, a proof of concept, sort of developing it. And then the last stage is called the initial public offering, IPO. And that's when revenue growth starts to slow a bit, but still positive. And later on, we're gonna hire Goldman Sachs and Morgan Stanley in our hypothetical example and take our company public. I'll teach you exactly how that works. Okay. So everything in between the IPO and the seed stage is called venture capital. Okay. And there's something called an A round and a B round and a C round. And basically what that means is this. When you're generating revenue and you already have seed investment or families investing in you or angel investments, it's all the same thing, and you need a lot of money to grow your business or hire employees or hire more engineers to create your product or add on to your product, you do what's called an A round. An A round is just the first round, the first time venture capital firms give you money, right? And so in this case, the A round is going to be led by Sequoia, okay? And then the B round is going to be led by Kleiner Perkins, which is another awesome venture capital firm. And then the last round before we go public will be led by Meritech, which is a late stage, incredible venture capital firm. And then we'll get some debt, but it's okay. I'll explain what that means later from Silicon Valley Bank. You said, wait a second, Chris, debt's bad. Let me explain that later. Later stage is okay to do it, not early stage. Okay. All right, so the A round is when Sequoia gives us a lot of money for our company, which will start soon. Or I'll give you more background on soon. And a year and a half after our A round, or 2 years later, we're going to run out of money. And so we're going to want to do a B round, again from Kleiner. Then 2 years later, whatever, we're going to need a little bit more money before we go public from Meritech, a great venture capital firm, and Silicon Valley Bank, right? And so from birth to IPO is usually 7 or 8 years for most great companies, okay? So we'll go through that. But right now, assume we're in the A round territory, okay? Okay. All right, so let's talk a little bit more about venture capital raising in terms. So what returns do venture capital firms look for? Well, they typically look for what's called a 5x5, right? And that means a 500% return within 5 years. Why so big? Because most investments go belly up, okay? In fact, most companies that get started end up declaring bankruptcy within a couple of years. Okay, what about valuation? Well, in venture capital, you never look at valuation this year or next year. In fact, the best investments you'll make in your life, whether they're private companies or public companies, ask yourself one question before analyzing that company, which is this. In 5 years, is this company that I might invest in going to be more relevant or less relevant than it is today? I can say that again. In 5 years, is this company going to be more relevant or less relevant than it is today? Okay. It teaches you to be a long-term investor like Warren Buffett, which works exceptionally well. Instead of playing the month-to-month gyrations of the idiotic hedge fund market where I used to work. There's a reason why I'm in venture capital now. And so in 5 years, this company is going to be more relevant or less relevant than it is today. And so let's say we're looking at Amazon or LinkedIn, two amazing companies. I think one day Amazon will have the largest market cap in the world, be the biggest company in the world. But if you look at earnings this year and next year, it's over 100 times earnings. And goodness, who would waste their money investing in that company? Well, a lot of people lost a lot of money shorting or betting against Amazon because they're just too short-term focused. Remember, you want to be long-term greedy, right? And so longer term, Amazon will make a ton of money. And the same thing with LinkedIn. People look at that company, ticker LNKD, and say, Chris, why would you invest in this company? It's got a price earnings ratio of over 100 times. It's expensive. Well, no, it's not. It actually has a price earnings ratio of 4 times. And then people say, what? No, it doesn't. I say, yes, it does. I get to more than $50 in earnings in 5 years in my model for LinkedIn. Right? And the company is trading today at, I don't know, around $200, whatever, which means it's only trading at 4 times my earnings estimate in 5 years. Okay. And so by thinking longer term, like asking yourself the 5-year question, you can ignore the volatility in between, right? You can pick the destination and not give a damn about the path. Let the hedge funds chase those data points, right? In fact, when you start to buy a stock, right, if it starts going down when you start beginning your position, you should be happy. You want it to go down so you can get it at a cheaper price, right, before you build your full position. Warren Buffett, who guest lectured in one of my classes at Columbia years ago, he said something amazing. He said that the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. How prophetic is that? Brilliant. Okay, so valuation, you look at least 5 years out, okay? And it all depends on what the sector is to come up with your valuation benchmark. Don't worry, when we cover the valuation section in this course much later from now, I'll cover that in great detail, okay? Okay, fantastic. So how do you pitch to a venture capital firm? Well, you want to have 3 pitches, a 30-second pitch, a 5-minute pitch, and a 30-minute pitch. The 30-second pitch is the most important one. You want to make it simple to understand so that a 6-year-old can understand, or pardon me, a grade 6 student or 6th grade student can understand what your company does in one sentence. We are the Uber of the hotel market, or we're the Airbnb of the condo market, or whatever it is. 30-second pitch is important. That's your elevator pitch. Because if people understand that pitch, you'll get your first meeting. Okay, and then you'll present the slides, which I showed you how to present earlier. In terms of the content of those slides for pitching, to a venture capital firm, give me a class or two before I show you exactly how to do that. Okay, you want to sell yourself. Nothing is more important than that. You also want to talk about, what's different about your product, what makes it incredibly unique. You want to talk about the competition and the market. You always want to know the size of the TAM, or total addressable market. They'll ask you that question. If you don't get that right, they'll think that you don't know what you're talking about. You want to have very basic financials ready. Just a couple of annual, revenue expense line items. Less is more. And you want to talk about who your partners are, who your advisors are on your board, who are your investors, that sort of thing. You want to show the product. A lot of people don't do that. Show the product right away. You want to keep it simple. Be passionate. Be interesting. Speak from the heart. Less is always more. So in terms of the venture capital industry here in the United States, about half of venture capital is here in the Bay Area. And it's here because of something called Sputnik, right? Which is a Russian rocket, which is the first one to space. I'll talk about that more in another class. But most of the investments here in the U.S. are here in the San Francisco Bay Area. Okay. So why technology venture capital? Why now? We talked about it before. The price of computing has come down materially. And so there's a lot of great investment opportunities for us and for you right now for starting a company.